Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Sylvia Jablonski, CEO and CIO at Defiance ETFs. We're talking about the broader market and some very interesting thematic ETFs today. Sylvia, welcome back. Thanks for joining us today.
Thanks so much for having me. Happy to be here.
So I wanted to start with your thoughts on recent stock market performance. And we know that stocks struggled in February after a very impressive start to the year. And that is mainly because these recent economic reports suggest that the economy has remained remarkably resilient, and that may lead to the Fed raising rates more aggressively. So what do you think of the recent market performance? What do you expect in the coming months? Do you think the Fed can still manage a soft landing?
Yeah, that's the question of the day, or the question of the last year and into this year for sure. So I think, I think that when we started this year, I had some optimism because I thought that investors would start to look through, right? There is a lot of there's a lot of bad data out there in terms of, being a Fed. And we saw that, PCE, their preferred measure, came in hot, CPI came in too hot, PPI, jobs numbers, services inflation, things like that are just not coming down the way they should be. But on the other hand, it's something that is also unlikely to be linear. So my view on this is that time will tell. I think in the short term, we're going to have continued volatility and continued risk to equity markets, because if we get, another couple of months where the inflation data is inflated, that will lead the Fed to more than likely hike beyond 5.4%, right? That, the market's kind of been pricing in and along the lines of the 6% plus, which a lot of the Fed chairs have alluded to. But I think that if we kind of get back on track and we start seeing that overall inflation is actually continuing to head downward, what the Fed has done, is working. You've seen signs of rolling recessions. I mean, first of all, I think it's been, 15-month bear market, right? Which is tough to call if you haven't had the actual recession. But if you kind of look at the performance of the markets, you get those numbers there. You've seen it in housing. You've seen it in, certainly tech and these types of stocks. So my view is that in the short term, a lot of uncertainty, a lot of volatility. Equities are risky if you need short-term returns. However, my view on this is sort of the same as it was last year, and it's just tune the noise out, right? Because I think that if you can think beyond 2024, 2025, and if you think about where stocks are now, the likelihood that they will be trading at higher prices at that time when the Fed has, by then definitely stopped, right? And probably come off of higher for longer and started to go in the opposite direction, or close to it at least. I think, the market starts to rally, and that's really when you see wealth, growth and wealth development and generational wealth and things like that happen, is when you have these down markets and you kind of like, not close your eyes, but just have a disciplined approach of dollar cost averaging into the stocks you like that are on sale. And just kind of try to tune it out for the short term. In the short term, I mean, you probably are just better off with defensive types of allocations. It's hard to deny that.
So are there any certain areas of the market or stocks where you see a lot of opportunities for investors, particularly for investors who are longer term focused, looking at the longer term opportunities?
So I do. For about the last 3 to 6 months, I've been very high on stocks like NVIDIA and AMD, for example. And, I pay attention to semiconductor stocks because our firm, manages a lot of baskets and themes that require semiconductors to essentially run, whether it's, 5G or artificial intelligence and machine learning. So with the news of Microsoft investing the $10 billion in OpenAI, and that for whatever reason, investments in AI have been around for a long time, and it's been kind of growing behind the scenes. But for whatever reason, when that came out, it really, seemed to get investors really excited about it, and you started to see semiconductor stocks take off. if you look at some of the data out there, I think IDC is actually projecting that artificial intelligence will grow at a CAGR of 37% through 2026. But if you just think about what semiconductors sort of do and how much we need them in order for artificial intelligence, machine learning to actually come to fruition, I really think that those stocks that are still, they've had a good rebound into this year, but they're still far off of their 52-week highs. I mean, nobody has $100 or more off of its highest tick. So I do like those stocks. I've scooped a lot of them up this year, even though they've rallied. And then I like to think about the other players that are going to participate in AI and machine learning. And for me, those are tech stocks, but they're big tech stocks, and they're the stocks that everybody kind of hates right now. And we're down 20 to 40% last year, and they're to the tune of Microsoft, Google, Apple, Amazon, because I think that these companies, whether you like them or hate them, are going to be the leaders in AI innovation, in machine learning. And I think they're also going to apply these things to their business lines to increase efficiencies, to decrease costs, to make up for, the workers that they don't have, and to perhaps, even run, sort of meaner and leaner and improve margins regardless of what's happening with inflation. So I'm picking up some of those names on sale. I also just like to have some diversification. So we have talked about this before, but a clean energy types of allocations. Oil and gas is still very much necessary, and there's a huge demand story there. But I think as we think about globally going carbon neutral, and you think about like realistically, how does that play out? You need different types of elements and production inputs basically to generate electricity and energy and things like that. And so you start looking at things like hydrogen, for example, or solar energy as interesting parts of the market to invest in. So I like those companies too, particularly on the hydrogen side.
All very interesting areas for sure. And you talked about chips and big tech companies, and I totally agree with you. And particularly because of this hype surrounding artificial intelligence, we all know that AI feeds on huge amounts of data, and the technology would require enormous computing resources. So these companies, the largest, richest tech companies and semiconductor companies like NVIDIA and AMD, they would be the biggest beneficiaries. And continuing the conversation about ChatGPT and quantum computing related companies have also benefited a lot because investors are trying to figure out how to play this hot theme. And I read last week that Google claimed an important breakthrough, and they said that this is a major milestone in our journey to build a useful quantum computer. But I think investors still believe that quantum computing is something from, distant future. Real world applications are many years away. So what are your thoughts? What would you tell investors about who are looking to invest in quantum computing, and particularly say your ETF?
Yeah, so what I would say is that we actually picked the ticker quantum, QTUM, because of the thought process behind that was that artificial intelligence and machine learning applications are going to transform every industry that there is. And everyone is very focused on the word artificial intelligence, right? But in order to have artificial intelligence, you need to have machine learning. In order to have machine learning, you need to have data. You need to have data parsed and processed, and you need data to be collected in vast amounts, and you need that data to be processed quickly and put together in a meaningful way that actually allows for these, kind of bots and outputs and things like that. And I've heard of so many good examples of this, particularly in the medical field and medical research, where the way that researchers now, for example, might be working on a particular project in cardiology or something like that. And what they'll do is they'll manually call all of the hospitals that have doctors that are looking at that same field. And then, they'll try to get access to this computer in the Midwest that will take about 8 or 9 hours to generate the data they need. And then it's just kind of like a data dump, and they have to do something with it. So if you have quantum computing, which is the fancy word, which just basically means a supercomputer to do all of this quickly and efficiently, that data could get back to a doctor in a matter of minutes. And maybe that changes a surgical outcome, for example. So the reason why we think that, we actually wanted to create a quantum computing, a machine learning, and AI product. And we wanted to look at all of the companies, and there are about 70 of them that will benefit from the growth of all of this. So quantum is a really cool ticker for the supercomputing aspect of it. But if you look at the fund, it's just really giving investors access to those companies that we talked about, like NVIDIA, AMD, all Microsoft, IBM, Google, HP, just anyone who's really deeply involved in the space.
Right. I'm looking at the description of the fund. It says that quantum provides exposure to companies on the forefront of machine learning, quantum computing, cloud computing, and other transformative computing technologies. And all the companies that we discussed, they are among the top holdings in this ETF. Now, another ETF of yours, Defiance ETF, which has done quite well this year, is your travel ETF, CRUZ. And we know that we have seen a post-pandemic surge in travel demand, and we have also seen a shift in consumer spending from goods to services. But if inflation remains at elevated levels, there is a concern that investors may not be willing to spend a lot on airfares or hotels or cruises because they will have to spend more on food. And in fact, we have seen some shift in consumer spending. They are not spending a lot on discretionary items. They're spending because they have to spend more on food and other basic necessities of life. So what kind of outlook do you see for these travel stocks in the coming months? Do you think the surge that we have seen in their prices can continue?
I do. So I think it's a great point. And to give a very fair, transparent answer, I think that if we end up having a hard landing, which I would be surprised by for various reasons, one is wages, two is strong jobs, three is earnings are okay. We're not sort of, falling off a cliff here, suggesting that we're going to have a hard landing, but, it's all in the data, right? And so if that's the case, this will be impacted. But what we're actually seeing is a continued pickup in spending in this space. So to your point, there is less spending in goods. We've heard that from some of the retail earnings that came out this week, but there continues to be a lot of spending in the space of casinos, airlines, and hotels. And I think there are a lot of reasons for that. One, I think a lot of this travel has already been booked. And if you, kind of go back to the earnings calls, which, I know you guys cover everything and listen to all of this, but with Delta, United, American Airlines, whoever it might be, all of the CEOs were talking about improved margins, increased bookings, being 85% or higher pre-COVID bookings. Even the cruise lines that were just kind of DOA for the last 2 years, Norwegian has had a massive increase in bookings, and they're not so much, they're kind of the higher end cruise, so they are so recession affected. And then hotels are picking up because of business travel reopening, and again, more people traveling. So I do think that in the short term, so I think like this trade actually continues to make sense this year, because we just see it in the data. We see it in the TSA numbers. We see it in the airline bookings and things like that. So these companies are poised to grow this year. What happens after that will really depend on whether or not we go into, a doom and gloom recession. But my sense is that if we get, a landing of some sort, a soft landing, a medium landing and whatnot, maybe this area, is poised to suffer for a couple of months, and then you get an opportunity to kind of buy them up and hold them for a long term. But there's just been such a huge growth in this sector, and there was just so much pent up demand. And then, one thing that's super important to talk about that we sort of don't realize is that there is actually a massive reopening now of China and even Europe. I mean, it has been reopened, but they haven't been kind of back to pre-pandemic travel. But if you think about the reopening of China now, and not having to wear masks and quarantine and all these things, I mean, a lot of these things just happened, right? And when they opened it up, there was a massive setback because everybody got COVID again. But now, you're kind of seeing that data where, people are kind of getting back out there and spending. So I think you're going to reconnect East and West. We know that that continent loves to travel, loves to spend, loves to stay in hotels. And it's a, second largest economy. It's going to be a huge factor in travel. So I do think that CRUZ will have a good tailwind there.
Yeah, I agree with you. China reopening is a good point that could boost many of the travel stocks. Now, you also mentioned clean energy as one of the areas that you like now. And I wanted to talk about green hydrogen. So, hydrogen is often mentioned as the fuel of the future, and even big energy companies are investing in millions in green hydrogen projects, but the technology is not cost effective currently. In fact, Bill Gates said recently that green hydrogen is still about 4 times more expensive than it needs to be. And the recent Inflation Reduction Act actually includes some new incentives for green hydrogen that may benefit these companies. So, talk to us about your outlook for this area, this energy, whether it can become commercially viable in the coming years, and also tell us about your ETF.
So those are really interesting points. And I think it's important to think about, as you mentioned, that investors, should think about the different types of hydrogen that exist, right? So blue hydrogen is when nat gas is split into hydrogen and CO2, and greenhouse gases are captured, and it mitigates environmental impacts on the planet. Whereas green hydrogen is produced by splitting water by electrolysis. So there's a zero impact. There's no negative impact. There's no sort of storage or sort of debate. You also have, gray hydrogen, which is produced for many years. And it's not really, the CO2 is not really captured and it's released into the atmosphere. So it's considered sort of bad. So it is important to delineate the different types of hydrogen. So the companies that we're looking at are on, the cutting edge of hydrogen production, whether they're storing, helping to convert and things like that. So it's companies like Plug Power, Bloom Energy, ITM, Ballard, Sol is another one, Fuel Cell. And we do think there's a lot of reports that have come out about this. I'd be happy to even just, quote those, but Bank of America and Goldman have all, recently come out projecting that by 2050, it will be an $11 trillion space. The International Renewable Energy Association predicts that in the next 5 to 10 years, 12% of our energy will come, or our electricity will come from hydrogen. Right now, that number is 0%. So what is happening? To your point, right now, it's very expensive. It has in the past not been efficient, but these companies now are finding new efficiencies, and they are finding ways to reduce costs of production, storage, and conversion. So as this plays out, and like all sort of innovations, energy innovation is no different. You're going to start seeing this really monetize and revenues come soon. But you have some of this playing out all over the world already. You have fuel cell buses, you have airplanes, you have boats, you have power plants, backup generator power plants run by Microsoft and Amazon, using the energy resources created by companies like Plug Power, for example, and Bloom Energy. So this is playing out now. It's expensive. It's becoming less expensive year by year, and I do think that it's a trend that is here to stay. It's a viable alternative. Hydrogen is the most abundant element on the Earth, as we all probably remember from science class. So it's something that can support our population and energy needs in due time. Once the conversion is made fully efficient.
Excellent stuff, Sylvia. Thank you again for joining us today. Always a pleasure to have you on the show.
Thank you, Nina. Thanks for having me.
That was Sylvia Jablonski of Defiance ETFs. Let's recap the ETF tickers that we discussed and some more. So they're quantum computing ETF. So it's actually quantum computing, machine learning, cloud computing, and other transformative technologies ETF. The ticker symbol is QTUM, quantum. Their travel ETF is the Defiance Hotel, Airline, and Cruise ETF. Ticker symbol is CRUZ, CRUZ. It holds, as the name suggests, airline, hotel, and cruise stocks. The hydrogen, the ETF is the Defiance Next Gen H2 ETF, ticker symbol HDRO. Now, if you want to look at more travel and tourism ETFs, there are some more options. JETS ETF by US Global. This invests only in airlines, US and non-US airlines, and ticket symbol is JETS, as I mentioned. ETF MG also offers a travel ETF. It invests in travel technology firms. The ticker symbol is AWAY. Now, if you want to look at more hydrogen ETFs, there's another one by GlobalX. The ticker symbol is HYDR. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.